Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, February 17th, 2016. In this video, we'll take a look at gold, the near-term outlook for gold and the miners, GDX. So far today, in the last few days, I stated in the videos making the case that the markets might hold those support levels, which they did, and the bear flag patterns would be busted. And I'm referring to the broad markets. So all that's played out, and we are getting the quite a strong bounce in the broad markets, as is often the case when you see foiled bearish patterns. In other words, those bear flags that broke down on the 60-minute, the daily time frames, and those have now clearly been busted. So as I talked about the symmetry, you need to see an impulsive move out of those flags, and we only had a day or two to consolidate, if you will, after breaking down, and that's clearly didn't happen, and we've moved back up to those flags. So, and what you're seeing now is just a combination of long stepping in because those support levels held, and short covering. Now, why did I talk about the broad markets? Because this is, let's just dive into what I've referred to lately about gold being a flight to safety trade. Let's see, I have this chart here. Let's go ahead and change it to okay, what I did, I changed the black line. This is the primary line on this chart to IEF. That's the 7 to 10-year Treasury bond. Now, you can look at 30-year bonds, but typically during a flight to safety, you'll see institutions, which are referred to as a smart money, move into short-term bonds out to the medium term. Anywhere. So I'll look at the 10-year bond. You can look at it really any of the Treasury ETFs. You'll see a similar thing here, and this is what I pointed out recently. We've seen this chart's a little bit busy, but what I have here in the green line, this is the stock market, the S&P 500. Now we're only going back to just about the end of December, so this is looking, the last 2 months here. 30-minute time period chart, and you can see the market was correcting, the green line, and you can see that almost in lockstep, that move up with gold and Treasury bonds. And as I've been harping on, that's a flight to safety trade. Money is moving into safe havens, and although there are times where the market goes down and gold goes down, it's not perceived as a safe haven. It obviously has been lately, and this chart helps evidence that. You can see the move down right here. The black line again is the Treasury bonds. The blue line is gold using the GLD ETF, and so right here is where the market topped, and you can see that gold and Treasury bonds not coincidentally topped right after that and have been moving higher since. And this is what I pointed out here. Recently, the markets bottomed back last week, and we had this sharp move, very sharp move up. And you can see the black line here. We've had a very sharp move down in Treasuries. The blue line, we initially had a sell-off in gold. And then the last few days, we've seen this divergence. All of a sudden, today, gold is trading up, and the markets are sharply higher. As I do this video, they're up quite a bit, and Treasuries continue to sell off. Now, I've made mention several times in the trading room. TNX is the 10-year Treasury yield. We were just looking at Treasury bonds. Now we're looking at a chart of Treasury yields. And I mentioned on Thursday, I believe it was, Thursday, we had this gap down, and then on Friday we had a huge gap up. This is, I've talked about these patterns quite a bit, traded these on the sites. One of my favorite, most reliable reversal patterns is an island reversal. You can have an island cluster of several candlesticks, a strong move or a trend leading up to that gap, and then a gap up on the other side, leaving that candlestick, or in some cases you have a cluster of candlesticks alone. In other words, like an island separated from the rest. That is exactly what's happened here. And again, it was brought up several times recently. So what we're looking at is this move here, followed by the downtrend. That actually downtrend in Treasury goes back for years, and a powerful gap down followed by a gap up, and like I like to see, upside confirmation. This was an island reversal bottom, which is not. These signals aren't used as a 1-2 day trade. They usually are used, in my experience, fairly effectively to mark lasting trend reversals. So if that is the case, you'll see Treasuries continue to rise, and it won't be a straight move up. There's going to be moves against the trend as long as we remain above this level. So again, this changes a lot of what I'm seeing, and this is why for the last couple of weeks, even though it looked like the world was about to fall off a cliff there with the markets at support, they just couldn't catch a bid, and I remained near-term bullish, especially once I saw on Thursday, especially I should say into Friday, when I saw the smart money, if you will, start to exit treasury bonds. Remember, yields work inversely to the bond prices. So when we look at IEF or TLT, it's just an inverse of that chart. So here's the IEF chart, and you can see the same thing there, very clear. This shows bond prices. So there's your island top, about as good as it gets. That's a textbook island top reversal. And again, what I'm looking at now, and the reason I'm spending so much time on treasuries is because that is, as I said, that's where smart money goes. The bond market is much larger than the stock market, and that's where institutions, put their money. They move their money when there's a lot of volatility or fear that the stocks may drop. And you can see here on gold now we've also had an island top, and so far today, to my surprise, both gold and the miners are up. But that is just a day-to-day. This is just noise, in my opinion. This is a very, I should say, about as high probability of all the chart patterns I trade as you get out there. So where I'm going with this, I'm going to give you my near-term outlook on gold and GDX, but I also want to say that I remain open to the possibility of a much deeper correction and sell-off. And again, you just have to reference the last video I did pointing out that the miners had yet to, by every metric that I use, longest term metrics, remained in a bear market. And we haven't taken those really flipped long-term buy signals in any of those. Gold, yeah, had a pretty good week last week and a bullish breakout, but I'll talk on that here. But again, most importantly right now, if you're trading this daily time frame, and I do put a lot of weighting on the daily time frame, you can see this island cluster top, two candlesticks separated by a gap up leading up to them and then a gap down. So there's an island top. And if this plays out as expected, we're going to come down here. That's a support level. I don't have all my levels drawn on this chart. May bounce, maybe not. The one thing about this move in gold is parabolic runs, and this is a parabola. For those of you not familiar, this is a parabolic move in gold. Parabolic moves typically end is with prices coming down as quickly as they went up into the end of the parabola. I'm not looking for a move all the way back down here to the lows, but I could see easily some very sharp selling in the next week or so down. I mean, there's a bunch of gaps that have yet to be backfilled. And this is all that's happened recently here. We backfilled this gap right here from the other day. That would be our what I'd call, if this plays out, an exhaustion gap. This was your breakaway gap. We had a couple regular gaps in here. I'm sorry, this would have been a continuation gap up around this point. So we'll see. But more importantly, we can only forecast and predict so much what may happen. But the cold hard facts are this is a key support level that I've been watching for a few days. Surprised to see gold hold it today. But again, one day does not make a trend. And, I've added, at this point, I've just recently added some more short exposure to the miners because I do expect this level to go. That is that gap that I was looking at there. So we had a couple days trading history here. You can see the dates down below. I'm on a 15-minute chart. And, gold backtested and backfilled that gap the other day. As I mentioned, gaps are like magnets. They more often than not become backfilled at one point or another. And based on the move and everything else I'm looking at here, I fully expected an initial reaction on I should say a reaction on the initial tag or backfill that gap. That's usually the case, but we've had that now. So I think the next time we visit that level will be the last, and it'll probably give way. And then you have, you can draw the lines here. I don't have, as I mentioned, all these charts aren't mocked up, but there's nice support there. And of course, if we enter that gap, maybe you get a reaction at the top. I wouldn't be surprised to see us slice through the top and not stop until we backfill that gap there down around the 112.42 level. Here's some trend indicators right now. Gold has been, since gosh, all the way back in, looks like late January, this 2868 pair, which I'll use on a 15-minute time frame, has been on a buy signal bullish up to that point and crossed over here. So right now the trend indicator is bearish, which is one reason I'm expecting more downside. And as I mentioned in some of the recent videos, and over the years I've talked about this, it's so simple, but the zero line on any time frame on a MACD helps to find trends. And as I said, I usually use the last of the two to cross. That helps filter out whipsaw signals. So in this case, it would be the white line or the 9 EMA. And what you can see here is that signal by itself was bullish all the way up until this point, just the other day where it crossed down. And right about with that 2868 histogram that I'm using. And what you're seeing here is a bounce. And price is looks like the MACD is now rolling over. So once the zero line is broken, then it becomes resistance when tested from below. So those are, at least from the 15-minute charts, some of the things I'm looking at, because if we didn't have price indicators, momentum indicators, and oscillators to help figure out where prices might be going, then it would be a coin toss whether this support level holds and we bounce from there. It's the stuff down here and the things that I talked about on the daily chart, and really some other factors such as the fact we're seeing stocks rising in this flight to safety bid in gold so far started to play out with money coming out of gold, but today gold prices being up with stocks up, it's not jiving. It's not sitting well with me. So that's what I'm looking at, and let's take a look at the miners. Okay, here's GDX on a 15-minute time frame. This chart I've been posting quite a bit in the trading room lately. What we have here are clear, unmistakable bearish divergences, and actually, on the MACD double divergence, we had a divergent high here. Price has pushed on to make a second divergent high. So on my 2868 histogram, which has also gone bearish to a sell signal, the MACD on the 15-minute time frame is also bearish now, you can see here, and looks like it's curling down, meaning the MACD line is about to cross over the 9 EMA. It hasn't done it yet, given you want to see that confirmation and both lines pointing down, but so far look at where it's being rejected, right off that zero level, which again has defined uptrends and downtrends. Done a pretty good job. And the RSI, you can see the divergence. So the divergence is clear. There's your prices making higher high against the oscillators and indicators making lower highs. This uptrend line here is still my primary target. So I'm looking for the 17-18 level to go. That's also a gap on GDX, and prices have been holding up above there. We had that initial tag from above yesterday, and the expected bounce, and then I posted in the trading room here this 1780-ish level. Very well-defined resistance. 1, 2, 3 taps from above, 1, almost 2. We trade a little bit above there, but you can see how that level acted as resistance back here and support there. Once support is broken, it then becomes resistance. So it's pretty straightforward. And once and if that 1718 level goes, we'll probably have a pretty quick move down to this trend line. And then keep in mind the bigger picture is that this is a potential, you can call it a contracting channel, maybe a bearish rising wedge. It has that wedge shape to it. But the important thing is this trend line will be support, especially if we get a reaction. My expectation would be a reaction off the initial tag of that level because we haven't visited that level in a while. In other words, this was the last time we tagged that level. So a bounce there, oops, wrong tool. A bounce off that level would help to validate that trend line. So let's see, something like this, maybe a bounce. I'm not sure how far it would go, but that would then become resistance at 17, 18-ish level. We, of course, still have the resistance level up here. And then keep an eye on everything down here and see what happens. Maybe we set up some bullish divergences if that breaks down, maybe not. And if we do, then, of course, we have these other support levels / price targets down there. So that's GDX from a 15-minute time frame. And to wrap this video up, like I said, I'm primarily focused on the short-term charts now, but I never take my eye off the bigger picture. And, as I mentioned, that if these short-term scenarios play out, what happens is there's a domino effect. You tend to have some repercussions on the longer-term time frames that could lead to quite a much deeper sell-off. Right now, I'm just looking for a pullback, a little overbought, overextended, overbought pullback, if you will. And but that could play out. Let's say, for example, if GDX takes out this was a very well-defined, very important resistance level around 17 that was taken out. Now GDX is trading at 1745. So let's say we pull back, much below and close the week, well below 17. Then we're looking at more than likely a back test of this primary downtrend line. You can see the downtrend line that defined this large falling wedge pattern. So that would take us down. I'll try to put my crosshairs here. Let's just say it takes a week or two to get there. Remember, downtrend lines are downward sloping, so every day or every week as time goes by, they come in at a lower level. And that would be about let's try to quantify it. I have two variations of that downtrend line. One is about almost 7% below current levels. Again, that goes on throughout time, and the other's 9%. So, we go out, if it takes a few weeks to get back there, then now you're talking still around the 9%. Not much more if it gets there in a few weeks. So let's just call it about a 7 to 9% pullback. And that would be actually a very, a nice scenario to see for those who are longer-term bullish, like myself. I remain longer-term bullish the miners. I would love to position on a back test of those downtrend lines there. Might be a little bit too easy. That's why I'm a little skeptical. But then again, that's technical analysis, and sometimes I'll second guess a very obvious looking setup, but other times I just go ahead and trade the setups because you can quantify your entry, you can quantify your exit if you're wrong. And anyways, that's something I'm looking for now. Now, of course, we can, if this is a super mega bull market we've just kicked off, or at least a mega rally, then maybe we find support at that 17-ish level, and we move up from there. That's a possibility, but not my preferred scenario right now for the reasons that I discussed earlier, not to mention the extremely overbought nature of the mining stocks and gold right now. And let's flip over to the gold weekly chart, GLD, for a minute. This is a pattern, this sort of contracting descending channel that I've been, covering for years now, looking at this and stating this was a very important trend line. And yes, we took it out last week. But I also posted, because of the extreme overbought nature and everything else, this flight to safety rally that gold was catching, and the fact that now markets have found support and may be moving higher for a few weeks here. That's quite possibly, that's a very possible scenario, I should say. And now, but more importantly, I mentioned when we did break above that level last week and look poised to close above it, that the possibility was very real to see that this was a fake out or a false breakout move. And now, given today is only Wednesday, we're halfway through the week. Well, it's an abbreviated trading week, but yeah, we're halfway, 2 trading days into the week and 2 more to go. But right now, what you see here, this is the candlestick. We have fallen back below that level. So at this point, that is a bull trap, i.e. false breakout. However, I continue to reiterate, I only trade weekly closes when trading the weekly time frame. So the fact that we're trading below that level right now doesn't mean a whole lot to me. And if we do close below it, there's still a pretty decent support level right here. But that's something to watch for, because as I always say, the miners will ultimately follow the metal. If you want to know where GDX is going, you just have to get a good read on gold. And although there are very temporary disconnects between the two, you can plot any chart you want, of long-term chart of gold or the Huey index against the miners, gold and the miners, plot those together and you'll see that they move in lockstep. The miners are just if you will, a leveraged play on gold. They're going to move up a whole lot more. If you can get a 20% upside in gold, you're looking at maybe a 40% or more upside in the miners, given the right circumstances. So anyways, this is what I'm watching right now. The longer term picture, as you can see here with these bullish divergences, everything else remains constructive. So I won't go crazy if I see a close back below this level. I don't think that we'll revisit the bottom of that pattern. but it will give me some pause and probably keep me on the near-term bearish side, looking for a pullback, maybe down to that 112.87 level. I really didn't want to do long-term targets on this video. I just wanted to take a look at the short term. And then we'll wrap it up since we're looking long-term now. Let's look at the Huey real quick. For those of you who watched the video that I did last week on the mining stocks, I covered the Huey from this long-term perspective and mentioned everything. I touched on all these indicators being still on bearish sell signals, the PPO well below the zero line, the ROC 25 still in bearish territory, everything that was talked on. And very importantly, this 20-month moving average, which GDX just managed to kiss last week. But we fell back off it. We even closed, that last week we closed above it, I believe. But this is a monthly indicator, monthly chart. So the only thing that counts is we still have a couple weeks left in the month, and a little shy of 2 weeks. It's how we close. And right now, GDX is trading below that level, and that level has capped. It's just done an extremely good job of defining bull and bear markets. In other words, when the trend is bearish, it becomes resistance when tested from below, and when the trend is bullish, it becomes support when tested from above. Again, that was discussed in last week's video, so I won't spend any more time on it. So there's a near-term outlook for gold and the mining stocks. And as I said, it is largely dependent on what the stock market does, because if this rally just fizzles out and turns on a dime and we see some impulsive selling, then that will more than likely drive money back into treasuries, back into gold, those safe haven assets. And then any near-term pullback in the miners or gold will be limited. But right now, as I've stated in the last video I did on the broad markets, and I've been talking about in the trading room, my expectation is to continue to see a drift up in the markets this week into options expiration, which is this Friday. There was a tremendous amount of bearishness recently, as evidenced by that put-call ratio extreme that I pointed out, and everything else. So you have a lot of put buyers that need to be roasted this week. And once that happens, my best guess is that if we continue to move up this week, and then next week we'll have a decent pullback in the market. And again, I'll talk on the market in a separate video, but that's my outlook. Near term over the next couple days, near term bullish bias in equities, near term bearish bias in the miners, and I think they have a heck of a game of catching up to do if the market continues to move any higher from these levels. I think it'll become very apparent that flight to safety bid in gold is no longer justified at this point. So I think you'll see a lot of profit taking there. Okay, and this has been Randy Finney with Right Side of the Chart. Hope you enjoyed.